In this video, I'm going to show you how to adjust your covered call positions, especially when the stock price is running up and you run the risk of losing the stock, which is actually not your objective. Your objective of selling the covered call initially was just to generate some cash flow. A short disclaimer, please note that this is not a recommendation. We are not recommending any stock or any trade. This is purely for education purpose. Selling a covered call is a very common and a very popular strategy where investors, they own a certain stock and they sell a call at a price higher than the current market price and generate a cash flow in the process. But the problem with selling a covered call is that you're essentially capping the upside of your stock. Now, we are long-term investors and we do deep dive research in the businesses which we own, and we like to buy and hold the businesses for a very long period of time. So selling a call on those businesses, it directly contradicts with our long-term goals. But you know what? Sometimes, we are not perfect, and I sometimes am unable to resist the temptation of generating some short-term cash flows by selling calls. On this stock, that is Thor Industries, this is one of the companies that is part of my core portfolio, and I really like this business. But while I was acquiring the stock between a stock price of $45 and $65, I also succumbed to the temptation of selling some calls on this stock. Now, on the 22nd of July 2019, Thor Industries was trading between 56.5 and 58.7, and I already had a reasonably large position in Thor Industries, but I wanted to acquire some more shares. So I sold the 55 strike put expiring on 16th August, and I sold 11 contracts of that. So the total notional value of this transaction was 60,500, which is the money which I kept aside. I, in fact, park these notional amounts in a US Treasury, a short-term US Treasury, which gives me some yield while I'm waiting for a possible assignment. And the total cash inflow I received by selling this put was $1,100. The maximum risk of this trade is $59,400. Now, this is not exactly a risk because I was going to buy the stock anyway. I have positioned myself to acquire the stock at $55. So by generating the cash flow, I have actually reduced my total exposure. And the break even for this transaction is $54 a share. That is, if I end up getting assigned, my average purchase price for these 1100 shares would be around $54. And whenever I sell a put option, I always calculate the XIRR of this trade, and I'm only interested if that XIRR is reasonably high number. I look for a figure above 20%. The fact that the notional value of the trade is $60,500, which means if I'm to get assigned, this is the amount of money that I have to put up. And I don't like buying on margin, buying on leverage, so I'll actually put up the money to buy the stock. So while I'm waiting for the possible assignment, this money is parked in a short-term treasury. Now, the $1,100 of cash flow which I have generated, so that is like a return that I have generated on $60,500. But the good thing is that cash flow I have received upfront, and that gives me an XIRR of 30.7, which is excellent. So I'm more than happy to do this trade. Eventually, on the 16th of August, I ended up getting assigned on this stock. I purchased 1100 shares of Thor at $55. On 19th of August, which was a Monday, like a lot of people, I could not resist the temptation of generating some cash flows because, I saw the stock price was going down. So I thought maybe it's a good opportunity to generate some cash flow by selling some calls. So I sold 11 contracts of the October 55 call and I generated a cash flow of $990. In the interest of time, I'll just run through the trade quickly, and if you want to see the exact specification of the contract, you can just pause the video and you can look at the exact expiry date, the exact option premium that I earned, etc. So I ended up with a covered call position with 1100 shares plus 11 short calls. Now, if I had only 1100 shares, this is how the payoff diagram would look. It is a straight line. As the share price increases, my return from the position increases. But because I sold the call option, see how I chopped off my upside above the $55 strike price of the call. So while I generated a bit of a cash flow for myself, but I have completely capped off my upside. I have to mention here that 1100 shares is not the only position that I have in Thor. I actually have quite a large position. So in this particular case, I did not mind selling this call option. So here, this is how the payoff diagram works. So you can see this arrow is pointing at the max profit possible, which is $990. So the x-axis shows the profit and the y-axis is the share price. So above $55, my max profit is only $990 from this trade, even if the stock price reaches $100. Now, of course, I was not very happy about the fact that my max profit is capped. So on the 30th of September, I did an adjustment. I could see that the stock price was gradually inching up. So I rolled out and up the October call. So essentially I bought back the 11 contracts of the call and I sold the January 60 calls. And I did it using the spread trade. It's basically a diagonal spread where I bought back the October 55 call and I sold the January 60 call. And this trade I did at a credit of 15 cents. The purchase price for the October call was $5 and the selling price for the January call was $5.15. So that resulted in a credit of 15 cents per contract. And in the process, I generated some additional cash flow because I did the trade at a credit. So you can see that my max profit jumped from $990 to $6,655. I also slightly reduced my max risk. Why is that? Because I did this trade by bringing in a credit. So I brought in some additional cash flows. As you can see, I also slightly reduced the break-even point of that trade. So now, while my upside is still capped, at least I have created room to make a maximum of $6,655 profit instead of the earlier $990. But as I mentioned earlier, I don't like to cap my profits, especially because Thor was one of my core positions. So it's not very smart for me to cap the upside. So this is what I did on the 25th of October when the share price actually kept moving up. I further adjusted this trade. So adjustment 1 was the adjustment which I did on 30th of September, and the second adjustment, the adjustment 2, is what I did on this date, 25th of October. So I basically closed the Jan 60 calls by paying $10,208. So that's a lot of money which I paid up to close these calls. But I only did it with a goal to fund that $10,200 from some other option trade. I also wanted to do the adjustment in a way so that my max risk is contained or it comes down, and my biggest objective was to open up my upside. Now I wanted to achieve all these three through this one adjustment. So if you look at the price of the option which I bought back, it was $9.28. However, the option which I sold it at $19.75. So because of that, I could bring in the same cash that's required to close the 11 contracts by selling much fewer contracts. So I ended up selling only 5 contracts of the Jan 2260 calls. And along with that, I also sold 1 contract of the Jan 2175 calls. So only these 6 calls paid for whatever was required to close the earlier 11 contracts. So that way I reduced the number of short calls, and that's how I opened up the upside for my trade. Because remember, I have 1100 shares, so now I have only 6 short calls. So the profits on 500 shares have totally been uncapped. Now you can see that I reduced the max risk from 59,345 to 58,684. So my first goal was met. Total amount of cash that I brought in by selling these new calls was 10,869. So which is more than enough to fund the 10,200 that I spent to close the 11 contracts of the Jan 20 calls. So this is how I did the adjustment, where actually I brought in some net credit to close my short call position, open up my upside, and reduce the total risk. So as a result, fast forward to 14th February 2020, the Thor share price has shot up to $87 per share. And you can see that this particular position, there is the 1100 shares of Thor plus the short call contracts. Together, this is sitting on a profit of over $17,500. Now, this picture demonstrates, had I not done any adjustment on the original trade, if I just left the October 55 call, my shares would have got called on 18th of October, because the stock price has moved higher than the strike price of the call on this particular date. So I would have lost my shares. And my profit, while it's showing as $572 here, but this is actually the pre-expiry. The day is not fully over. So once the day is fully over, my profit would have been just $990. If I just stopped at adjustment 1, and had I not done the adjustment 2, then my profit on 17th of January 2020 would be just $6,655. And I would have lost my 1100 shares. Because I have done the 2 adjustments, I'm sitting on 14th of February 2020, I'm sitting on an unrealized profit of over $17,500. Now, on the expiry date of my current call options, which is 1 contract is expiring on 2021 January, and the balance 5 contracts are expiring in January 2022. So I will lose 600 shares. 600 shares will get called away. This is assuming the share price is above the call strike price. However, I will still retain 500 shares to enjoy the upside, and that too along with the dividends that the company will announce in between. So this is a great way to adjust a covered call when the stock is running up and we want to protect ourselves from losing all our shares. But frankly speaking, I mean, hindsight is 2020. I mean, sitting today, I feel that I would have been much better off without selling the call options, which is something which I told you right at the beginning. It doesn't make much sense if a company is part of your core position, you just do not want to cap the upside. But then having done it, this was the next best option available for me to adjust the trades in this particular way. Now, from time to time, we publish videos showing you a lot of interesting option trades. Sometime back, I had published a trade on Jumia, and we will keep doing that. If you are interested in checking out these trades, do register on moneywisesmart.com/research. It's completely free to register as of now, and we will also be sharing our future trades. I also invite you to join our Facebook group. The link is below. We discuss lots of interesting investment concepts. We share a lot of our research and also some interesting option trades. So do join the community. And if you have enjoyed this video, do hit the like button. That keeps us motivated, and do subscribe to our YouTube channel so that you get notified as and when we come up with new videos. And I promise you'll enjoy our videos. Thank you very much for your time.